Subclass 2.3 Guarantee Policy. The definition of a guarantee policy. A financial guarantee is a non-cancelable indemnity bond backed by an insurer to guarantee investors that principal and interest payments will be made. Many insurance companies specialize in financial guarantees and similar products that are used by debt issuers as a way of contracting investors. So they guarantee whatever they tell you, the promise they make, uh, and to attract investors as well. So when you look at construction guarantees, the construction industry requires a broad range of guarantees, the full complement of which our expert guarantee underwriters cater to includes the following: bid bonds guarantees or performance guarantees, advance payments guarantees, materials off-site and on-site guarantees, retention defects liability guarantees, supply guarantees, and utility guarantees. A performance guarantee. A performance guarantee is issued by an insurance company or a bank to a contractor to guarantee the full and due performance of the contract according to the plans and specifications. Should the contract fail to construct the building according to the specifications laid out by the contract, the client is guaranteed compensation for any monetary losses up to the amount of the performance bond. So if you take out the bond for the bank, they will guarantee uh, that the house will be according to the plans, and that the contractor must comply with that. And if the contractor does not, the bank will guarantee any losses so that the client won't suffer. Advance payment guarantees. An advance payment guarantee is used when the contract provides for an advance payment to be made to the seller, and it guarantees that the advance payment will be returned to the buyer if the seller does not fulfill its obligations on delivery of the goods or services. Materials off-site and on-site guarantees. Contracts make provisions for the payment to the contractor for material deliveries on-site but not yet built into the contract and yet claimable under the contract as detailed in the bill of quantities. Such materials may be on-site or off-site or may be in the process of manufacture. Payment will generally be made by the owner against such a guarantee, and the guarantee will be for the full value of the payment. Retention or defects liability guarantees. In addition to requesting a performance guarantee, the employer will insist on withholding a percentage of payment due to the contractor for the continued performance of the contract. He may allow the contractor to produce a retention guarantee in lieu of cash retention, and this may occur during construction or after completion of the works during the maintenance period. So normally you'll tell him you withhold 20%, but the bank guarantees the contractor will get that money if the building is finished and they are happy and satisfied. Then the bank will guarantee that they will pay the last 20% or whatever to the contractor. So the contractor knows that money is guaranteed. He must just fulfill his part of the contract. Supply guarantees. That creates the same rights and obligations as a performance guarantee, whereby the guarantor guarantees the supplies of goods in terms of a contract supplier. Utility guarantees. Guarantees as required by the municipalities for the supply of electricity for the service station business. Currently, the retailer has the option to make a cash deposit at the municipality or provide them with a bank guarantee to satisfy their deposit requirements. The refined utility guarantee is an ABSA insurance company insurance policy which can be lodged as acceptable security for the municipality, thus releasing current deposits or guarantees issued. A guarantee is a security to the municipality in the event that the retailer defaults on his electricity account. Trade guarantees. These are guarantees that typically cater for industries such as the freight forwarding, clearing, and logistics. Such guarantees include Transnet guarantees, Transnet Freight Rail, TFR or Portnet, that is the ports at the harbours. Custom guarantees, deferred duty and VAT, bonded warehouse, road temporary import, custom rebate, manufacturer or excisable product, commercial fuel guarantees to fuel majors, and airline guarantees. Lombard Guarantee General and Commercial offers the full spectrum of guarantees required by clearing and forwarding agents, warehousemen, and transporters. These include custom guarantees, including deferment guarantees, bonded warehouse guarantees, and national consignor bond guarantees, as well as the full spectrum of guarantees required by Transnet, the National Ports Authority, NPA, not the National Prosecuting Authority, the Transnet National Ports Authority. Transnet Port Terminals, the TPT, and Transnet Freight Rail, the TFR, airlines locally and internationally. Custom guarantees. Logistic guarantees are offered as security to SARS, customs, or the logistics supplier in line with their policy. The guarantee usually states that if the client does not adhere to the terms as laid out by the beneficiary of the guarantee, the beneficiary can claim such payment against the guarantee. This could cover payment of deferment accounts, acquittals into a bonded warehouse or consignor bond, or for a credit line offered by Transnet for port usage. Commercial fuel guarantees. Guarantees as required by the fuel company to enable the commercial customers to purchase fuel and lubricants products on a credit basis. A commercial customer is a direct purchaser of fuel and lubricants products from the fuel company. This can range from any business purchasing regular fuel product from the fuel company to bus and transport companies, farmers, mines, etc. Fuel retail guarantees. Guarantees as required by the fuel company to enable the retailer to trade on a debit payment system as opposed to prepayment by form of hard cash or bank guaranteed checks. The fuel guarantee is an acceptable alternative to the traditional bank guarantee, which is secured by cash or assets. The fuel guarantee can also substitute the traditional bank guarantee, as retailers are able to replace their existing bank guarantees with the refined guarantee, releasing valuable capital tied up which can be reinvested into the business. What is fidelity guarantee insurance? A fidelity guarantee, as issued by the insurers, is a contract of insurance and also contract of guarantee to which the general principles of insurance apply. It does not guarantee the employee's honesty, but it does guarantee that if the employer suffers any direct financial loss arising out of the employee's dishonesty, the insurers share indemnity uh, the insurers shall indemnify the said loss to the employer within the limitations prescribed by the contract. So, if a big company has got a lot of employees and they are not honest and they steal from the company or from the clients, they've got insurance, fidelity insurance, to cover those costs. Types of fidelity guarantees. You get individual policy. This policy covers an individual for a stated amount. Collective policy. This policy covers a group of employees. The insured decides the amount of guarantee required for each individual according to his or her responsibility and position. A schedule is included in the policy. Floater policy. A single amount is shown in the policy which represents the insurer's liability in respect of any one individual and its total liabilities in respect of all the employees guaranteed who are individually named in the schedule. Such type of policies is granted where the number of persons to be guaranteed is not less than 5. Blanket policy. The insurer in certain selected cases issues blanket policies without the names of the guaranteed persons being shown in respect of all employees who are grouped according to categories, for example, all the employees handling the cash or other clerical staff, etc. They are all putting under one blanket. They are issued to large, well-established business houses conducting business with sound practices. What is trade or credit insurance? Trade credit insurance is an insurance policy your company can take out in order to protect against non-payment of your debtors. The purpose of your trade credit insurance policy is to give your company much needed protection, which should your customers fail to pay the debts they owe you due to insolvency, bankruptcy, or protracted default, which is failure to pay without the agreed terms and conditions. How trade credit insurance works. Now let's have a look. If your customers cannot or will not pay you, the domestic or international trade credit policy you have will cover you. Therefore, with your policy, you can now trade with your customers with a peace of mind that you would not have without trade credit insurance policy. Four main benefits of credit insurance: protect your cash flow, enhance your customer relationships, improving banking relationships and access to finance, and supporting sales expansion. And that is the end of this uh, subclass. If you've got any questions, you know what to do.